Hello, and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, Moody's warns of systemic risk from the leveraged lending market, and this comes after asset management companies begin their buyback and buying an accumulation of companies from the stock market using lended money from the capital markets, as well as that European bond markets do take a hit after Italy's plans for more borrowing is made known. But that with lots to talk about. Obviously, also on the charts, we've got lots happening, which we'll come to near the end. And as well as that, we've got lots happening on the economic calendar. So stay around to see the end when we'll be talking about that. But let's get straight into it. So firstly, to talk about obviously is Moody, which warns of systemic risk from the lending market. Now, credit rating agency, Moody's has warned of a race to the bottom between banks and private credit funds financing risky leveraged buyouts. Now, the renewed appetite to lend on such deals and greater competition from the fast-growing private debt sector risked funneling more money into lower quality deals, just as economic conditions are deteriorating. And this is something we've been talking about a lot in relation to economic conditions and their deteriorating status, and that's mainly in relation to how a lot of economies were kind of heading more towards a recession, and especially that's the case still for the Eurozone. Now, it's less so an issue now in the US, however, they're still in dire economic shape, as well as the UK, which has obviously got its own problems in relation to the economy. And I guess this is all in line with the results that always come with having higher borrowing costs as a result of having extraordinary high interest rates. And now this now Moody's analyst Christina Paget commented, saying this will cause pricing terms and credit quality to erode, fueling systemic risk. And what's systemic risk? Well, essentially in relation to when one bank fails, the banks that have been kind of in relation to it, or kind of got too close to it, too close relations to that bank, do end up failing as well due to too high a reliance, and therefore one bank's fall can cause five others to fail as well. Now, this all comes as the private equity market looks to find its footing following the Fed's last year, aggressively hiking monetary policy. Now they rose rates, in the tens consecutive times, 14 consecutive times, I do believe, for the Bank of England, and similar number of times for the Fed as well, and this kind of obviously rocked financial markets and dramatically dented deal making. But now fears of a recession is subsiding. Firms are once again looking for large buyouts and in turn requesting large loans from financial institutions. And this is common, with any large buyout. It's hard to really find that available, liquidity to kind of go into these large acquisition deals or merger deals, just by how much is required for the purchase of a company. Remember, these companies are often in the billions, and if we just think back to Elon Musk's Twitter acquisition, he used a great deal of lended money in order to accumulate Twitter, now known as X. But now fears of a recession is subsiding. Firms are once again looking for large buyouts, as I said, and in requests, looking for these large loans, and therefore, what you're kind of seeing is an almost over leveraged market in relation to buying up all these companies which are now being able to be purchased in a kind of risky and issue filled capital market that we're encountering nowadays, with many private equity firms over the last 2 years turning to the $1.5 trillion credit industry, such as Blackstone's $10.2 billion loan, which was used to buy the software maker Zendesk. So obviously, this has been happening over the past 2 years, but it's increasingly becoming a risk in relation to the increased competition between, the private credit firms, as well as now the banks, which are kind of usually got a more conservative loan policy. However, now with this competition, it's kind of forcing them to take more risky loans, issue more risky loans, and therefore, encounter and, risk a greater amount of capital within the markets. And now, as the market for lending opens back up, banks are also facing competition from private credit firms, just as I said, private credit funds, just as I said. That said, banks have remained conservative on buyouts. They are willing to finance. So it's kind of this competition and, differing kind of styles to the capital markets, with these private credit funds being kind of more risk prone and, kind of happy to take on that risk, whereas these, banks are more conservative in terms of their risk tolerance. Their appetite, however, has started to return as prices in the loan market have rebounded, and fund managers eagerly to buy up lowly rate corporate bonds and loans start to accumulate those kind of loans and bonds, and therefore they're kind of put in position where they can't win. This rebound has been partly driven by the precipitous drop in loan issuance, with the new high yield bond sales at their lowest level since the immediate aftermath of the 2008 financial crisis. So there's not as much to go around, therefore forcing them to kind of take more risky deals. But that's all for that article. Next to talk about, obviously, is the European bond market, which has been hit hard by Italy's plans for higher borrowing. And obviously, recently we've been talking about issues around Giorgia Meloni's kind of record and rhetoric around the economy, especially in relation to more isolationist views, and also her kind of stance against the ECB, kind of taking the ECB on in relation to rates being too high and therefore making it too hard for homeowners to own property. But this is kind of something that we often see with these populist leaders, which will often just side with whatever the public opinion is, regardless of the economic nuance. Now, European government bond prices did drop sharply on Thursday as investors took fright as Italy's larger than expected budget deficit and mounting concerns that central banks will keep rates high for an extended period took effect. Now, Italian 10-year government bond yields rose as much as 0.17 percentage points to 4.6%, reaching their highest level in a decade. And this came following Prime Minister Giorgia Meloni's government raised the fiscal deficit targets and cut growth forecasts, obviously in line with increased government spending. Now, investors said concerns that the US Federal Reserve would hold rates higher for longer were spreading to European markets, and we've been seeing this across the FX market this entire week in response to the Fed's rhetoric. And this has been shown, in terms of people taking their money out the euro, people taking their money out the pound and putting it in the dollar, where they expect a higher and a safer interest rate for longer. Now, in the euro area, the prospect of higher Italian borrowing came after the French government was criticised by the country's fiscal watchdog on Wednesday for not cutting public spending enough. And Mike Riddle, a fixed income portfolio manager at Allianz Global Investors, commented on the events by saying, the narrative that's been taken over is a fiscal story, saying also, budget deficits are likely to be bigger than previously expected, so you have to do the re-emergence of bond vigilantes. Now, German yields also climbed as high as 2.998%, reaching their highest levels for more than a decade. And this all comes after central banks have signalled that while they're close to ending the historic series of interest rate increases, their expected rates are expected to stay high long enough to ensure inflation comes down to targets. And this is what we've been talking about a lot recently, especially in relation to the ECB and the Bank of England most recently, commenting on keeping rates where they were, despite previous expectations for rate hikes by those two central banks. However, they did comment that, they are looking to keep rates where they are until, they see significant change in inflation and a significant, kind of sign that, the economy is cooling off and they're reaching their inflation targets. Because we do have to remember the inflation targets for many of these countries and nations, is 2%, and a lot of these nations are in the 4% to 8% territory for inflation, with the UK kind of being around the 6% level of inflation recently, and Europe being more close to the 4% kind of territory. But that all said, they are kind of talking about rates being at their peak. But, if they're keeping rates where they are for a long period of time, this by no means means that we're heading back into the low interest rate economy that we saw prior to these rate hikes. Now, US Treasury yields also climbed since the Fed's last week. The Fed last week spoke of rates possibly being raised further and being kept higher for longer, and we spoke about this a lot, and it had a great effect on the dollar, obviously, and obviously is spread across to European markets now, with the Fed talking about possibly raising rates later this year. And this was in contrast to the ECB and the Bank of England, as I've said multiple times now, that who wanted to kind of keep rates where they were and not raise them any further. And so all the money kind of went into the dollar, which was an inverse to what was actually predicted and expected. Italy's government late on Wednesday predicted this year's financial deficit would come in at 5.3% of gross domestic product, which is up the 4.5% target it set in April. So a significant rise in the expected fiscal deficit, which obviously is going to have a great effect on bonds, which kind of depend on the government's ability to pay back loans, and therefore if the government is taking on more debt, it's less likely to pay back the rest of the debt, and therefore the trustworthiness is removed or decreases, and therefore bond prices fall and yields go up. And this was all citing the soaring costs of the controversial tax credit scheme for home improvements. So government spending, or at least tax breaks, so that homes could be improved despite high interest rates. But that's all for the articles. Next to talk about really is on the charts, and with that being the US indices. Now, we've been talking about the US indices a lot recently, largely in relation to their decline following the Fed's rhetoric around inflation and raising rates, and in response to the Fed's guidance being more hawkish. Obviously US indices declined, but in contrast to that, yesterday we did see a rebound in US indices, kind of making some gains, however not too significant, to be honest. Now, they did move up after punching some lower liquidity levels, but then again they haven't kind of broken and pushed above these prior highs, especially on the Dow Jones. Now, on the Nasdaq, however, it's looking more optimistic, breaking out of this prior channel, which it was kind of, moving down in. And after it kind of reached this area of liquidity, after breaking below the market, it was able to find the liquidity to push higher. And now it's kind of tapping certain Fibonacci levels. In terms of where it might go in the future, if we were looking at shorts, obviously the 61.8% area is looking good, due to it being, a strong area of liquidity prior, as well as the confluence in relation to the Fibonacci retracement tool. That said, we've also got the 50% area here and the 38.2 it's at right now. So keep your eyes on that, because it will be very interesting to see how it plays out. Now, it's a similar story for the S&P 500, but really to talk about next is the dollar, which has seen a bit of a retracement, and this is coming after the dollar's rally following the Fed's guidance being more hawkish, and most recently yesterday it kind of saw a decline and a bit of retracement. Now, in terms of the overall fundamental and long-term message and kind of image of the dollar, it does seem bullish still, just simply based off the Fed's guidance. It still doesn't seem like any other nation is providing enough of a hawkish position or any data which reference a possible change in the hawkish kind of policy making decisions within their monetary policy committees. It seems that only the Fed is taking a hawkish stance at this moment, and therefore it makes sense that in the long term the dollar will continue to rally. But that said, we did see a kind of fall off for the dollar yesterday. So it'll be interesting to see whether it will just retrace to a certain level before making some further highs, possibly reaching this 50% level where we've got some prior areas of resistance which now may likely be used for support for the upside. So it'll be interesting, and keep your eye on the dollar. And staying kind of on the topic of the dollar, we have Euro USD to talk about, which is sort of in an interesting position, basically because yesterday we saw German inflation data come out, and essentially it did come in below target, therefore creating a response of a bullish drive on the euro, as people kind of saw lower inflation. Well, that's better value for the euro. However, I'm kind of looking at this on the more long-term side, where although we've seen the gains on the euro as a result of that, and better inflation data, lower levels of inflation obviously mean that the value of the currency increases. At the same time, we have to remember that this all plays into the position of the ECB. And if the ECB is seeing lower inflation, they're more inclined to reduce rates earlier, therefore, causing a decline in the value of the euro, because lower rates means less interest earned on keeping your money in the euro. And so with the dollar falling off and, the euro having some gains, I think this is still a short area. After punching this area of liquidity in the 38.2% fib, I definitely see this still as a kind of more bearish area, and it's just achieved a retracement following being oversold on the RSI. And next to talk about really is pound yen, which is looking to recover. Obviously it broke below this channel following the Bank of England's rhetoric as well as inflation data, and we kind of thought we were going to see a run to the downside after it kind of wicked into this 50% Fibonacci area, which is a strong area of liquidity. However, it does seem resistant to moving lower, possibly based on the general and long-term fundamental picture of pound yen. And so it'll be interesting to see where pound yen goes from here. Possibly it creates a double top and continues lower, or it may now consolidate as it seems to be doing. But next to talk about, of course, is Bitcoin, which has received some great levels of volatility. Now, I recently commented on the Bitcoin status, talking about how it generally follows the trend of accumulating within this area before doing false breakouts, as we saw there, as well as up there. And then once again we kind of saw it here, and then once we kind of failed to make any gains from this 38.2% fib, I kind of said, oh well, now that we're returning below this area of resistance, I think we're probably going to hover around this area. But it does seem that the charts have proved me wrong, and once again we've spiked up into this area of liquidity, nearly spiked up into that area of liquidity, which we've returned to a few times before, and now we're kind of looking more bullish on Bitcoin, which failed to return back to this area of accumulation. So possibly this area is now invalid, and we're looking more bullish on Bitcoin. So keep your eyes on that, and keep your eyes on whether Bitcoin continues bullish, or it once again returns back to this area of accumulation, which it's sat in for some time. Next I'll talk about really though is gold, which has continued to the downside, falling off quite hard following the Fed's guidance around raising rates later this year. And it really does seem to have hurt Bitcoin seriously. And in addition to that, with other commodities kind of making a gain, all the money's kind of flowed out of gold into oil, or gold or the dollar, which both have a higher rate of return than gold at the moment interest wise, and therefore people just don't see gold as a worthy asset to hold at the moment. But that's all for gold really. Keep your eyes on it, obviously, because now we've broken below these prior lows. It'll be interesting to see what market ends up shaping up for gold. But lastly, to talk about on the charts really is oil, which we spoke about did rally following breaching into this area of liquidity and nearing the 61.8% fib. And it did use that area of liquidity to push higher, and it's now hit this Fibonacci extension area of minus 27.2%. And it's now taken a bit of a retracement as people have sold off their kind of shares in oil, their percentages and equity in oil, as it neared the $95 a barrel mark for US oil, and it kind of has retraced a bit. As for the overall fundamental picture of gold, obviously it still seems very bullish, just considering the recent US stockpiles data, which did come in below expectations, therefore meaning the supply of it was lower than expected, and therefore scarcity is higher, along with the rhetoric from Saudi Arabia and Russia around cutting oil supplies for longer, has all added to the overall bullish position of oil and the look for Brent crude oil to possibly reach the $100 a barrel mark. So it'll be interesting to see where oil does go from this area of retracement and whether it does go higher. But that's all for the charts really. Next to talk about, of course, is the economic calendar, with so much happening today on this Friday. But firstly, we have Japanese unemployment rate figure coming out along with the industrial production for Japan, as well as the Japanese consumer confidence data. So, lots of Japanese data coming out today. As well as that, we have German retail sales, which obviously always plays into inflation predicting, as that's a major part of consumption. As well as that, we've also got UK GDP growth rate, as well as French inflation rate and German unemployment rate. So a lot of Eurozone data also coming out today, so keep your eyes on that. As well as, as I said, Eurozone core inflation. And this is obviously very influential, as well as the ECB's president Lagarde speech, which obviously has a great effect on the markets in relation to shaping predictions around monetary policy for the ECB. Now, as well as that, we've also got Canadian GDP change, which will be interesting to see, especially if you're looking at predictions on any Canadian pairs. As well as that, we've got US core PCE price index figures coming out, as well as the Michigan consumer sentiment figure. But that's all for today. That's all for the economic calendar. That's all for the charts, and that's all for the significant articles of the day. I hope you have a great trading day. That's all from us at Wildwood Capital. Have a great one. See you later. Bye.